Is the world ready for a Chinese stock market crash? Investors should probably brace themselves for further volatility. Almost everything about China stretches the imagination. A country of more than 1 billion people that has become the world's second largest economy in a matter of decades. China now makes 14.9% of global gross domestic product against less than 4% in 1990 and sucks in more than half the world's commodity exports. Its economy was valued at $12.84 trillion in 2017, up from just $1.2 tn at the start of the millennium, even if it still trails the U.S. at $19.4 tn. Its stock market performance can also boggle the mind. In 2006, at the peak of the emerging markets hype, it grew 83%, according to MSCI, then another 66% in 2007. The next year, during the financial crisis, it fell 51%, but last year grew 54%. China does not do anything by halves. Despite all these achievements, investors are starting to get edgy. Actually, that is not true. They have been edgy for years. We live in skeptical times and nobody quite believes the Chinese miracle can really be true. As the economy slows and its debts pile up, many fear it could crash and take the global economy with it. No question about it, China is now too big to fail. There are certainly reasons to be worried, with McKinsey Global Institute suggesting China's debts have quadrupled since 2007. Its total debt is now about 234% of gross GDP. The IMF says, a figure that could hit 300% by 2022. This has to end badly, doesn't it? The economy is still rattling along, though, up at an annual rate of 6.7% in the second quarter, a figure most of the developed world can only dream about. True, that marked a dip from 6.8% in the first quarter, with the domestic property market, factory output, and export growth all slipping. Economic outlook. Craig Botham, emerging markets economist at Schroders, says China's economy has also been squeezed by the government's crackdown on riskier lending, which has driven up corporate borrowing costs. Like many, he is also skeptical about official figures. While GDP growth appears to be holding steady, he is worried by more violent perturbations of high-frequency data, which suggests the economy may be decelerating at a faster pace. Mr. Botham says policymakers are working to offset the slowdown with more monetary and fiscal stimulus, but this will take time to come through. We could see a recovery at the start of 2019, but by then growth will be facing headwinds from the building trade wars. Amiel van den Heiligenberg, head of asset allocation at Legal and General Asset Management, is also concerned about China's financial stability, which is reflected in recent weakness in Chinese A shares and its currency, the Yuan. The Chinese economic hard landing or credit crisis is one of the biggest macro risks out there. As such, investors need to pay attention. President Xi Jinping is now prioritizing stability over growth in his second term, shrinking the shadow banking system and slowing credit growth, which is triggering a rise in defaults, but he believes action now should safeguard the global economy. The MSCI China Index fell 3.1% in July and Hong Kong's Hang Seng dropped 11%, and Andy Rothman, investment strategist at fund manager Matthews Asia, said anxiety is growing. Chinese retail investors are nervous that government attempts to de-risk the financial system will stifle growth. Yet corporate earnings remain firm, and he says that China is still the world's best consumer story. President Donald Trump's increasingly aggressive trade war threats continue to worry stock markets, but Mr. Rothman is calm, believing the bilateral tariff dispute will be resolved in the autumn, and even if it isn't, investors should not panic. If I am wrong, and it escalates into a real trade war, the impact on the Chinese economy will not be dramatic, he adds. Chris Beauchamp, chief market analyst at online trading platform IG, which has offices in Dubai, says markets are slowly becoming immune to Mr. Trump's trade war talk. He recently turned the rhetoric all the way up to 11 with his announcement that $500 billion of Chinese goods could suffer penalties, but markets quickly recovered from their initial shock, which suggests this kind of news flash is starting to lose its power. Stephen Downey, chartered financial analyst candidate at Holborn Assets in Dubai, says investors should not panic and retain their exposure to the Chinese economy. Corporate profits tend to grow in line with GDP, and China is still growing strongly, if you believe the public statistics. Many investors access China through a wider emerging markets mutual fund or exchange-traded fund to spread risk. Vanguard FTSE Emerging Markets Index ETF is 36.4% invested in China, far ahead of its second holding Taiwan, at 14.6%, and India, in third place at 11.1%. Other popular ETFs include A's China Large Cap ETF, A's MSCI China ETF, and SPDR's NP China ETF. Popular mutual funds include Matthews China Dividend Fund, Invesco Greater China Fund, and Fidelity China Region Fund. Russ Mould, investment director at online trading platform EdgeBell, says investors should brace themselves for further volatility. Doubts persist as to whether China really can grow at 6 to 7% a year, if only because of the law of large numbers. Something that grows at 7% every year for a decade doubles in size, and that's quite a feat, even for China. The authorities are trying to shift the economy from construction, manufacturing, and exports to consumption and financial services. This could take time and may lead to some lumps and bumps along the way. However, the ruling party's legitimacy rests on jobs and prosperity, so it won't want any slip-ups. Share performance is not always tied to economic growth, Mr. Mould notes. Big names such as Alibaba, Baidu, and Tencent have all soared even while the Shanghai Composite Index has been in the doldrums, while the technology sector is red-hot, especially given China's blossoming internet and e-commerce boom. The Chinese yuan is sliding in value, making now a cheaper entry point for overseas investors. A cheaper currency could act as a shock absorber against U.S. tariffs and also help boost exports. Mr. Mould says China is a complex case. While investors should retain their exposure, they should also approach with caution. China's economy could continue to be very stop-start, as the authorities are likely to panic on signs of any slowdown. In the still unlikely event that China did crash, the consequences could also stretch the imagination. Chinese equities come in from the cold. Outside investors have been wary of buying direct Chinese equities, preferring mutual funds and exchange-traded funds instead. However, Russ Mould, investment director at online trading platform EdgeBell, says the 5 biggest Chinese companies, Alibaba, Tencent, JD.com, YY, and 58.com, are now too big to ignore. All 5 offer exposure to booming Chinese demand for online products and services, in a land with 1 billion mobile phones. Investors think these stocks will also prove relatively immune to any slowdown in the broader economy or a trade dispute with the U.S. The top 5 are a play on China's rapidly developing digital economy for investors seeking fast earnings growth and healthy capital gains. Tech giant Tencent Holdings' sprawling operations cover social media, mobile gaming, payment systems, web portals, and its massively popular mobile chat service WeChat, and last year, its market cap burst through the $500 billion mark, briefly surpassing Facebook. Saxo Bank even suggested it could become the world's first $1 trillion company, but recent earnings and margins disappointed, and its cap has dipped to $409 BN. Alibaba Group Holding, which offers e-commerce, web portals, payment services, and cloud computing, has overtaken Tencent, with a market cap of $447.8 BN, and Mr. Mould says it is a genuine multinational with a presence in over 100 countries. JD.com, with a market cap of $46 BN, is a major e-commerce player that reportedly has the world's largest drone delivery system, while online classifieds and listing platform 58.com has a market cap of $9.8 BN, and video-based social network YY.com weighs in at around $4.65 BN. Mr. Mould says all 5 can use their huge domestic market as a springboard to overseas success. The Chinese stock market is not easy for overseas investors, but all 5 firms now have overseas listings. Alibaba and 58.com are traded on the New York Stock Exchange, JD.com, and YY.com are on Nasdaq, while Tencent is listed on the Hong Kong Stock Exchange, and also via American Depository Receipts, in the U.S. However, Mr. Mould says that after posting stunning growth, these stocks have become very expensive. They are pricing in an awful lot of future growth, so they have some lofty expectations to meet. Mr. Mold cautions that they operate in fast-moving, competitive markets where obsolescence is a key risk. Very few technology firms stay at the will. The stock market crash, the cause of the US-China trade war? The U.S. economy is on the verge of a market crash. Meanwhile, Asian markets continue to gain with the ongoing trade negotiations between China and the U.S. Last week, the Trump administration's economic advisor, Larry Kudlow, said that there is a genuine economic boom for the U.S. economy, despite the retaliatory tariffs from several countries. He also said that the government is crushing it, as there will be coming a lot of investments from all over the world. But despite these statements, David Stockman, the former Office of Management and Budget Director during the Reagan administration, thinks otherwise. Stockman believes that the current administration's decision to impose tariffs on China is a big reason for the current instability of the American economy. He also said that this decision could put stocks in a more volatile situation, per CNBC. Not the first cynical prediction. Since S&P 500's bull market began 9 years ago, Stockman has predicted that the stocks will experience a 40 to 70% drop, citing that there is a correction every 7 or 8 years. He made this comment at the same time when the Trump administration was about to approve its tax overhaul plan. Just last June, he also made a forecast that S&P 500 will plunge to 1,600, but S&P remained bullish. As of this writing, it is trading at 2,850.13. Stockman's predictions have yet to push through. Ongoing tariff talks. Citing a report from the Wall Street Journal, a separate CNBC article detailed that the U.S. and China are aiming to resolve their trade disputes by November of this year. Additionally, U.S. officials and Chinese delegates will meet on August 22 and August 23. With the ongoing negotiations, Asian markets experienced more gains as investors may have possibly expected better outcomes, per MarketWatch. Japanese stocks like Shiseido and Asahi gained 1.91% and 0.41%, respectively. For Hong Kong, Tencent added 2%. Southeast Asian stocks are also ahead, with Thailand's Siam Commercial Bank increasing over 1% and Indonesia's Astra International rising 2.5%.